I had a client refinance their mortgage 3 years ago. A lower rate, a lower payment. It felt like winning. But here's what happened. That refinance extended their debt by 7 years and cost them an extra $87,000 in interest. They thought they were building wealth. They were actually delaying it. And the banks knew exactly what was happening. This is the refinancing trap that quietly destroys Canadian homeowners. Let's go. If you're thinking about refinancing your mortgage right now, I need you to understand something before you sign anything. Refinancing, it feels like winning. You get a lower payment, a lower rate, more breathing room, and sometimes it's absolutely the smartest move. Sometimes refinancing can completely change your financial life, but sometimes that better mortgage actually costs you tens of thousands more long term, and you won't realize it until years later. Here's why. Most people only look at one thing when they refinance, the monthly payment. And that's exactly where people get burned. A lower payment, it doesn't automatically mean a better financial position. That's the part the industry doesn't want you to understand, because lower payments, they feel good, and good feelings make you sign documents quickly. So let me walk you through the exact mistakes that trap homeowners in refinancing decisions that they're always going to regret. Number one, only focusing on the interest rate. This is the biggest psychological trap in the mortgage industry, hands down, because lenders know people, they're obsessed over rates. So every ad says the same thing: lowest rate, best rate, special rate. I don't care what the fuck you call it. It works. People see a lower number and they think they're saving money. Maybe, maybe not. But here's why. Sometimes the lowest rate comes with a brutal hidden cost, restricted terms that lock you in for sure, and penalties that destroy you if your life changes. Higher fees that are constantly buried in the fine print, and probably less flexibility when you need it later. Now imagine this scenario. Lender A offers you a rate that's 0.25% lower than Lender B. You think, oh yeah, I'm saving money. But Lender A has a $5,000 prepayment penalty. Lender A charges $800 in setup fees, and Lender A restricts your flexibility that you can't access a HELOC, you can't make extra payments above 20% per year, and you can't refinance without brutal penalties. Lender B, they charge $1,500 in fees, but you can pay down the mortgage freely. You can access the HELOC at any point in time. You can refinance whenever you want. The same rate difference, but completely different outcomes. So smart homeowners, they stop asking, what's the rate? And they start asking, what's the total cost of this strategy? What am I giving up for that rate? It's a very different conversation. Mistake number two, not shopping around. This one quietly costs Canadians thousands of dollars every single year, because most people refinance with their existing bank. And I understand why. It feels easier, it's comfortable, it's familiar. They already have your information, but here's the reality. Banks, they're not your friends. They're in business, and businesses optimize for profit, not loyalty. Your bank is not automatically giving you the best deal because you've been with them for years. They don't care. That's not how pricing works. Different lenders view risk differently. Different lenders have different penalties. Different lenders have different refi structures, and the differences can be massive. I had a client who got a quote from their bank at 5.29. They shopped around. They found a non-bank lender at 4.94. Same quality of mortgage, same terms, 35 basis points lower. On a $500K mortgage, that's $1,750 per year in savings. Over 5 years, we're talking $9,000. Their bank never mentioned that rate was available. Why would they? They're optimizing for profit, not for you. Now, another thing people worry about here is multiple credit checks. They think shopping around destroys their credit score. That's mostly misunderstood. Mortgage inquiries during a short shopping period, usually within 14 days, they're grouped together by the credit system. The system understands you're comparing lenders. That's normal behavior. So if you're refinancing, shop properly, not just for a rate, but for flexibility, for penalties, for communication, for long-term strategy, because the cheapest mortgage today, it's not always the cheapest mortgage long-term. Mistake number three, ignoring the break-even point on the refi. This is where the math gets real, and this is where I see the most regret, because refinancing, it's never free, even when people say it is. There is always cost somewhere. There's legal fees, appraisal fees, discharge penalties, title insurance, setup costs. Maybe those fees get rolled into the mortgage balance so you don't see it. And when they do, psychologically you ignore them. They think it's rolled in so it doesn't cost anything. But rolling costs into the mortgage, it doesn't eliminate them. It just hides them. Let's run some numbers here. Say refinancing saves you $250 per month on your payment. Sounds good, right? But the refi costs $7,000 total. It takes 28 months over 2 years just to break even. That $250 per month saved, you don't actually realize any of it until month 29. Now ask yourself, how long are you keeping this mortgage for? Are you moving in the next 2 years? Are you selling the house? Are you upsetting? Are you going to upsize and need more cash later? You're going to refinance again? Change jobs? Because if you break the mortgage before reaching that break-even point, you may never actually realize the savings you thought you were getting. In fact, you might lose money. That's why refining should never be emotional. It should be tactical and mathematical. You should know your break-even point before you sign anything. Because if your break-even is 28 months and you're not 100% certain you're going to keep the mortgage for 30 months minimum, you shouldn't refinance. End of discussion. That's the discipline that separates wealth builders from people who just feel better temporarily. Mistake number 4, resetting the mortgage clock every single time. This one is incredibly common, and honestly, a lot of people don't even realize they're doing it. Here's the pattern. You've been paying your mortgage for 7 years. Your original term was 25 years. You're now 28% through that 25-year journey. Then rates drop. You refi, and instead of keeping the same amortization timeline, which is 18 years remaining, you restart into a fresh 25-year. Why? Because the payment feels lower, and lower payments feel good. But there's a hidden trade-off. You just added 7 years of debt back to your timeline. 7 years. Let me explain to you what that cost. Original mortgage, $400,000 at 5.5%, 25-year amortization. Monthly payment is just over $2,200 per month. After 7 years of payments, you pay down roughly $112,000 in principal. Remaining balance, $288,000. Remaining amortization, 18 years. Now we see a rate drop. Offer is 4.5 on a fresh refi. Option A, keep the 18-year amortization on $288,000. The new payment is $1,770. You save almost $500 per month, and you're debt-free in 18 years. Option B, you restart into a 25-year amortization, the same mortgage, but the payment is $1,456. You now save $811 per month, but you're not debt-free for 25 years. That extra 7 years cost you an additional $58,000 in interest. $58,000 for $314 in monthly savings. Most homeowners sadly pick option B. They see the lower payment, they're emotional, and they sign. They don't realize they just extended their debt timeline by 7 years and cost themselves nearly $60,000. That's the trap. Now, does that automatically make it wrong? No. Sometimes improving cash flow is absolutely the right move, especially during expensive seasons of life. I'm living it. Kids, business pressure, income changes. Life happens. But many homeowners, they lower the payment without realizing how much extra interest they're creating long term. That's the real cost. And this is why I always tell people, a mortgage is not just about surviving the month. It's about building your future. And there's a huge difference between lowering payments and increasing wealth. Smart homeowners, they understand the difference. Mistake number 5, trying to perfectly time rates. This is the worst. It destroys decision making because everybody thinks they know where rates are going next. They're going to drop. I should wait 6 months. I think fixed rates are coming down soon. Maybe, maybe not. No one knows with certainty. Not economists, not banks, not financial experts. Nobody. And waiting has a cost too. Because if refinancing improves your cash flow today and reduces your stress today, but you wait another year hoping for a slightly lower rate, you may have lost a full year of breathing room chasing perfection that never exists. You may have lost that period of financial flexibility when you actually needed it. That's the hidden cost of rate timing. It's not just about that 0.1% you might save next month. It's about the years of financial stress you'll live through waiting for it. That matters. This is why I always say, don't try to perfectly win the rate game, win the cash flow game. That's the real goal. Financial flexibility coupled with monthly breathing room. Reduce stress, better positioning. That matters so much more than bragging about a slightly lower rate. Because here's the thing. Most Canadians, they're one emergency away from financial stress. One job loss, one major repair, one health scare. When that happens, do you want to have gone into 25-year amortization to save $300 per month? No. You want flexibility. You want cash flow. You want breathing room. That's wealth building. That's what separates wealthy people from people who survive. And honestly, this is the biggest mindset shift that most Canadians need around their mortgage. Your mortgage is not just debt, it's a tool. And tools can either build freedom or quietly keep you stuck, depending on how you use them. A hammer can build a house or destroy one. Same tool, different outcome. Your mortgage is the same. That's why strategy matters more than rate every single time. Because here's what happens to homeowners who chase rates. They refi whenever rates drop. They reset their clock every time. They optimize for the monthly payment. And 25 years later, they're shocked they're still paying the mortgage debt. They thought they were winning. The banks definitely won on this one. Compare that to homeowners who refi strategically. They refi only when the math makes sense. They protect their amortization timeline. They prioritize debt reduction over payment reduction. And 25 years later, they're debt free at 55 instead of 70. That's the difference strategy makes. So let's recap the 5 biggest refinancing mistakes today in Canada. Number 1, only focusing on the interest rate without understanding the full contract. Number 2, not shopping around and assuming your bank gives you the best deal. In fact, don't shop around. Come see me, a mortgage broker, who will do it for you. Number 3, ignoring the break-even point and refining without knowing when you actually see the savings. Number 4, resetting the mortgage clock repeatedly and extending your debt timeline by years. And number 5, trying to perfectly time rates instead of optimizing for cash flow and flexibility. If you avoid these 5 mistakes, you immediately put yourself ahead of most homeowners financially, because most people make mortgage decisions emotionally and irrationally, chasing the lowest payment or the lowest rate. The wealthy make them strategically. They ask, does this build my future or does it just make the month feel better? That's the difference. And that's the wealth building mentality. If this video helped you think differently about refinancing or mortgages, hit subscribe, because this is what I talk about all the time here on this channel. When you're done with this one, go check out my last video where I break down why an insured approval might hurt your offer in a bidding war.